We're joined on INSEAD Knowledge by Christopher Fawcett, CEO of Fauchier Partners. You've been taking part in a session here at the Leadership Summit at INSEAD in Europe. You were saying that you think that hedge funds have been considered as being something of a scapegoat. Why do you feel that?
I think there's a general tendency to sort of, when things are going wrong, to find something or somebody to blame. And in the early stage of the crisis, the banks were not being directly blamed, and the hedge funds were. And I think this was convenient from the point of view of politicians. That lasted for a while. As people have become more aware of the facts, it has been less the case. And for example, now people realize that banks are sort of geared sort of 25, 30, 40 times to 1, whereas typically the average hedge fund is about 2 to 1.
From the numbers you quoted in the session, that you're saying that hedge funds really don't move markets.
They're not big enough. I mean, at the moment, hedge funds are about 3% of global money under management. They use a bit of leverage, about 1.5 times. That means if you take the total balance sheet of all the hedge funds in the world, it's smaller than the balance sheet of a big bank like JP Morgan or Royal Bank of Scotland or that sort of thing. So they're just not big enough to move whole markets.
Do you think, though, that there's still an argument that regulation is needed in this area?
Yeah, I think the right type of regulation, yes. I mean, there's a move now to, winding back a little bit. In Europe, for example, all hedge fund managers are regulated. In the US, currently they're not. And there is a move that all hedge fund managers in the US should be regulated. And I think everybody would welcome that. That leaves the question of the fund they manage, which is typically in a sort of zero tax jurisdiction like Cayman or Bermuda. And those are not technically regulated. What we're likely to see coming out of the Financial Stability Forum are rules whereby the larger hedge funds post their positions to the regulators. So the regulators are made aware of the positions of the big hedge funds.
You were saying that hedge funds have been pretty vocal in the past, that they've been prepared to stand up to companies. Could you elaborate a bit further on that?
Typically they will get involved in a situation where either they've identified a company which they think is badly managed, they will acquire enough shares in it for it to have a sort of meaningful stake, and that they will make initially sort of behind the scenes suggestions to management. If those aren't listened to and they have a high level of conviction, they like to go public on it.
And so they are prepared to stand up and be countered.
Yes, absolutely, yeah. And they are not answerable to big financial institutions. They're independent bodies, hedge funds. So they have no conflicts of interest from that point of view.
This was a session about shareholder value. It didn't really touch upon it that much. But Jack Welch, interestingly, made some scathing comments about shareholder value recently, calling it a dumb idea, even though he had been kind of looking at the quarterly numbers pretty regularly. Do you think that companies need to move away from short-termism?
Well, it's difficult. At the end of the day, corporate management is guided by its shareholders. But the problem with the current system is most shareholders don't vote. You get index tracker funds, ETFs, people who just don't turn up and vote, which means that management is very powerful in many cases, hence some of these excessive pay packages you've seen. And the question is, who is sort of the custodian of shareholder value? What the shareholder gets is a dividend, and a lot of those have been cut recently. And it's interesting to see how little fuss has been about it. It's almost as though shareholders felt it was a sensible thing to do. And the other thing a shareholder's got is the resale value of his shares. We're talking about quoted companies here. And the resale value of his shares is often determined by how the company is perceived in the market. And that is not just short-term financials. And some companies just are on higher ratings than others because they're considered to be high quality. And I think the shareholder value is the quality of the whole enterprise, not just the financials.
We've seen a failure of risk management right across the board. I mean, is it that boards in themselves have not been asking the right questions?
To some extent, yes, but let's not forget that a lot of the entities that got in trouble were regulated. They were audited, and there's not much talk about auditors at the moment. And in many cases, what's behind all this are the credit rating agencies, the S&P and Moody's ratings. And that wasn't just a creation of the sort of private sector, because all the Basel capital adequacy ratios, which are the central banking sort of mantra, were based on credit rating agencies. So it's a systemic failure of regulation.
And that's what you would say we need at the moment?
I think it needs,
as Andrew Lodge was pointing out,
a complete rethink, a much more common sense approach. It will become highly quantitative. and the belief in the credit rating agencies was quite irrational.
There are a lot of problems still to work out in the financial sector. Even at the time when governments are going to be pumping money in to stimulate economies, keep economies moving. On the other hand, we're going to have to sort out toxic asset issues and so on. How do you see things progressing?
But you could have simultaneously a reluctance to lend by the banks and also a reluctance to borrow. I mean, at the moment, there's less demand for borrowing.
And that would be basically bringing everything to a grinding halt.
Exactly. And interestingly, I saw yesterday that the UK mortgage borrowers paid back more mortgage borrowing in the last quarter than they've ever done historically. People have paid off their mortgages faster than in the past, and individuals want to reduce debt. At the same time, you have banks who are not keen to lend, which means you get a contraction of balance sheets.
There is a trust issue here, a fundamental trust issue right across the board. How do we get around that?
I think it's got to be rebuilt. There's a lack of trust in the balance sheets of financial institutions, and partial nationalisation is clearly a solution there. And there's a lack of trust in the senior management of a lot of financial institutions. I think it's got to be rebuilt slowly, probably change of leadership in certain cases.
And until that trust comes back, there'll be little confidence.
There'll be little confidence.
People won't be spending money, and the economy won't start growing.
And then the big number is going to be unemployment. It's been creeping up in most countries, pretty fast in the US. At the moment, interest rates are low, so people aren't paying much on their mortgages, for example. And although bonuses are down, most people have still got their jobs. The real issue is whether unemployment climbs up. And that, I think, is the single biggest threat out there, is unemployment.
How long do you think we're going to be going through this issue? Is it likely we could see recovery by the end of the year?
Well, apparently, if you look back at recessions which were triggered by a credit crunch, credit banking crisis, there's never been a V-shaped recovery, which doesn't mean that things won't stabilize. And my own guess is they'll stabilize somewhere around the current levels. The speed of recovery is a completely different story. And I mean, house prices, I noticed, for example, in America, didn't move for 10 years after the savings and loans crisis in 1990. So you could have just flat house prices.
Christopher Fawcett, CEO of Fauchier Partners, thanks for joining us.
Thanks a lot.